Welcome to Accounting 202, Managerial Accounting at Kapiolani Community College. In this video, we'll take a look at the notes for Chapter 14 and see about how to do fundamental financial analysis, as well as get an idea about what kinds of information sources you have available to use for your team project. First of all, when analysts want to see how a company might do in the future, they use fundamental financial analysis to do so. This is an analysis of the balance sheet, income statement, and statement of cash flows of a company, and they compare the company's performance and position over time to see if they can predict into the future. They also compare their company to other companies of a similar size in the same industry to see how they stack up against their competition in terms of competitive placement. So some of the basic tools of fundamental financial analysis are, number one, horizontal or trend analysis. In horizontal or trend analysis, you take the current year's amount, subtract the prior year's amount on any financial statement, if you have 2 years financial statements, and then divide that change amount by the dollar amount of the prior year. So that'll tell you the percentage change from one year to the next. That's called horizontal or trend analysis. So statements might be made like, our year-to-year sales are up 3% over 2017, something like that. Next, you have vertical or common size analysis. A common tool of this is what's known as common size financial statements. So that could, for example, take something like CVS drugstores and compare them to, say, Walgreens. And even though the dollar amounts of sales or assets and so forth might be vastly different, one placed on a percentage only basis, you can take a look at the inner workings of how the company is structured and what makes it tick. So to do vertical or common size analysis, you take some number on the financial statement, be it total sales or total assets on a balance sheet, and then you divide whatever other number you're looking at by that base number. So in this example showing in the notes here, the base is sales and everything else is expressed as a percentage of sales. Ratio analysis is a way of looking at the numbers for a company and drawing meaningful conclusions about their interrelationships. There are 3 major types used in our textbook: liquidity, profitability, and solvency, and you'll see a wide variety of these in practice. They need some kind of basis of comparison in order for a ratio to be meaningful. You can compare your company to another company of similar size in our industry. You can compare your company to the industry average for our entire industry, and you can compare your company to itself in earlier years. All of these are ways to get meaningful comparison data. And there are lots of tools available to learn about fundamental financial analysis. The best item for you to get familiar with is a service known as Mergent Online. It's available from the UH Manoa library system, and so if you have a UH Manoa library card, not a KCC library card, then you can go and access Mergent Online and get statistical reports and ratio reports for any publicly traded company. Publicly traded company means any company whose stock you can buy. So the way to get at it is find libraries at UH, number one. So you can go to uhhawaii.edu, search for libraries. And so I want to go to databases at UH Manoa Library System and ask for a service called Mergent. Mergent Online is the name of the service. And say, for example, I want to get information about a retail business such as, let's try CVS. And there are jillions of retail businesses that you can look up and see if you can find something creative. CVS Health Corp is the name of the CVS that we know as Long's Drugs. and I can find the company's financials over a period of time. Notice this last 5 years stacked up. There's my balance sheet. Here's my income statement. I can also go to find ratios directly, and my standard ratio report for my company, I can just get 3 years would be plenty because I'm only going to need one. And that'll tell me for their year ended 12/31/16, these are the profitability, liquidity, and then they have what are known as debt management and asset management ratios. And those are kind of similar to solvency, although per share really comes straight off of the income statement. So it's more like a profitability typically, but book value. So if I want to, then I can download this file in Excel, and then I have a local copy of it I can keep and use that to do my charts and so forth. Right? Got that? Okay. So there's one tool there. If no one on your team has a UH Manoa library card and you can't get a friend to help you with it or sponsor you, then you can always go physically up to UH Manoa. I would recommend Hamilton as opposed to Sinclair because I think they might have a little bit better reference desk in the Hamilton library, and ask them to use the system there. Once you're in the library, you don't need the library card in order to access Mergent Online. It's the library resource. Other things you can do a web search for the IBM guide for financial statements. That's a guide that's been around for quite some time, and they're not doing a lot of advertising with it, so it's really kind of there just for help. Also, you can check out Investopedia, WikiInvest, or Fool.com. All of them have substantial amounts of advertising, and Fool.com wants a subscription for their premium information and that kind of thing. However, you can still get real good pieces of free information from there even without signing up for one of their services. If you do fall for it and decide to sign up for a service, just make sure that you cancel within the 30-day cancellation period so you don't get your charge card charged. You can also go to finance.google.com or finance.yahoo.com. Both of those will get you into information about a company's stock. However, you have to keep in mind that if you're looking at google.com or yahoo.com for your company, and we want to find out about how they operate and what's their latest performance like, notice this information is really up to the date. So that means that because we're looking at our companies as of, for example, December 31st, 2016, this information is beyond the time period where we're actually analyzing. So the only thing we can do here is find articles about our company from back during the period where we're looking at, and sometimes find historical information about, say, for example, their stock price at December 31st, 2016. So January 9th, December 30th, January 30th, December 30th, 154, apparently the last day of trading for the year 2016. $154.40 per share. So that's a good thing to have available, although anything after that period of time doesn't count, basically because it's not in the period where we're analyzing. We're analyzing the period 12/31/16 and earlier, typically just that immediate year. You can also do a reverse search on something called annual statement studies, and though there will be a limited number of responses on annual statement studies, all the web pages that refer to it are deeply and heavily involved in fundamental financial analysis. So you might find some goodies there just by searching. Before getting into specific ratio computations, let's take a look at the resources that are available for you on Wiley Plus. In Wiley Plus, you have under Read, Study, and Practice for a particular chapter, applied skills videos, such as this one here that walks you through during a horizontal analysis.
$20,000, we determine the percent of the net sales.
And a vertical analysis.
Cost.
We also have Excel videos and resources, interactive tutorials that walk you through and ask you for some input as you go along the way, and solution walkthrough videos. So all of these are ways to see how to put together the data to do an analysis of a company when you have to create your own ratios. By and large, though, for your team project, you won't need to create your own ratios since you can get the data, as I showed you, from Mergent Online. So it's more a matter of interpreting the data as opposed to actually calculating it. However, it's really, really helpful to know how the ratios are calculated so that you can make a reasonable inferences about what caused the changes in your company's ratios. So you're really going to be looking for changes or patterns in your company's ratio over time and for them versus their competitors. So let's look now at specific ratios. Noted 3 types of ratios: liquidity, profitability, and solvency that your book defines. The first one, liquidity, involves primarily current assets and current liabilities. It looks at the company's ability to come up with money to pay for their debts that are coming due soon and other cash needs. And the party that cares the most about these ratios are short-term creditors. Those are people who are going to loan the company money for, say, 2 years or less. And in the case of very short-term creditors, we might be looking at a matter of months or even weeks. One of the major ratios is the current ratio, which looks at the relationship of current assets, that's cash, receivables, inventory, prepaids, and other accounts investments, short-term investments, and current liabilities such as accounts payable, salaries and wages payable, taxes payable, short-term notes payable, and the relationship between those is computed by taking the current assets divided by current liabilities. In this case here, I made up these numbers and I came up with a current ratio of 2.0. If you do a quick ratio, that's your cash and short-term investments and receivables, but not inventory most significantly. So it's a tougher ratio, also sometimes known as the acid test ratio. So this tells you just about nothing unless you have something to compare it to. You want to look at the current ratio for this year, and if last year's was 1.9, then that's an improvement. If last year's was 2.2, then we're not in as good a shape as we were last year. We could also compare it to other companies specifically or in our industry and decide how we stack up against them shoulder to shoulder. Another ratio, the receivables turnover ratio, looks at sales, or net sales really, and your average receivables. That's your pure mathematical average receivable. That's last year's receivable plus this year's receivable, add together, divide by 2. And so sales divided by that average receivable tells you like how many times your receivables on average were collected during the year. So this is looking like we're only collecting our receivables about every 2 months. You take the 360-day year that Wiley Plus wants you to use, divide by the receivable turnover, and you'll get the days to collect or average collection period. Inventory turnover is another key liquidity ratio. This tells you how quickly you can turn your inventory into sales, basically. Not necessarily cash, though. So take cost of goods sold, and again, average inventory, that's the mathematical average of last year's ending, this year's ending, add together, divide by 2. Get average inventory. And in this case, if cost of goods sold was 1.5 million, average inventory is 300,000, we'd have an inventory turnover of 5 times. This tells you how quickly we cycle through our inventory or how quickly we're able to use our inventory to make sales. And in the case of a Wiley Plus type computation where they want you to use a 360-day year, an inventory turnover of 5 times would come out to be about 72 days for us to sell our inventory, or number of days that are held in inventory. The operating cycle is a third ratio that makes use of both of these guys. You take the days in inventory, 72 days for example, and the days to collect your receivables, and that tells you the amount of time it takes from when you first get the merchandise to when you get the cash from the customer. Profitability ratios tell you about the income or the operating success of the company for a period of time, and stock investors are really interested in profitability ratios. So several of them are these guys showing here in my list, and you can find even more of them in industry, out on the web, and in Mergent Online, but these are some major ones right here. Solvency ratios tell you about how long you can expect for that company to last. So the party that cares the most about them would be long-term creditors, because they're talking about, for example, financing a mortgage or purchasing a bulk amount of bonds from a company. And in the case of solvency ratios, there are several that are important to creditors, and there are large variations on these. So one of them is debt to total assets. There's also debt to equity. So we look at our total liabilities, divide by total assets, or we look at our total liabilities, divide by stockholders' equity, and you'd say things like, for example, 3 out of every $10 of our assets are financed through debt, or for every $1 of equity, we have $2 of debt, or whatever the case ends up being. Times interest earned is also another important thing for a company that relies on financing in order to operate and needs financing. The amount of times that they can cover the interest charge on their borrowed money is very important, because if that number gets down really low, that means they're barely able to pay for the money that's required to make them operate. Sustainable income is an idea that has more to do with longevity than it does ecology. And if you talk about something called earnings power, look at the concept of income from continuing operations. If you look at income from continuing operations, that kind of tells you what you can expect in the future. There are lots of things that come into the income statement after income from continuing operations, so therefore it's a purer, cleaner number to look at to try to impute what might happen for your company in the future. Some things that happen also on a company's income statement, or that are sort of unusual items. Discontinued operation is when a company gets rid of a major chunk of itself, and it's shown after income from continuing operations. So this is a one-time item that you wouldn't expect to see again in the near future. Extraordinary items, these are items that are really unusual and infrequent, and they're also shown after income from continuing operations. So it means they're not very normal for the line of business you're in, and you're not going to expect them to see them again in the near future. A change in accounting principle involves changing the way we do accounting for an important thing such as inventory or taxes or so forth. And what's needed then is to show the cumulative effect of that change on all your prior year's income, and that's also shown after income from continuing operation. One more thing, comprehensive income or other comprehensive income is a way of sort of hiding gains or losses. When you looked at investments in other companies' stocks and bonds in chapter 12, available for sale securities, you noted that for available for sale securities, if there was an unrealized gain or an unrealized loss, you just show it in the stockholders' equity section. It doesn't flow through your income statement like it would if they were trading securities. So that's an example of an item of comprehensive income. And what does net of taxes mean? It means if you take the amount of the income that you're looking at and then you compute the tax on just that income amount, what is the actual sort of take-home pay from that income? The flip side of that is if you have a loss, then how much does it save you in taxes? And therefore, what is your true loss after considering that you had a loss that was kind of counteracted somewhat by tax savings? So, quality of earnings has to do with concepts of full disclosure and transparency. And we're trying to get as honest a picture we can of the company's financials, and that's often hard to do. And also because there's typically a lot of technical terminology that's tough to wade through. Earnings management is a pleasant or polite way to say the company has been window dressing their financial statements to try to make readers think something about them that may not be true. So things you could do to do that are numerous. This is just one list of possible things that a company could do. For example, you could say our collectibles are highly collectible. We have very little chance of uncollectible accounts. And so they would set their allowance for doubtful accounts at an unrealistically low amount. This is an example of what happened with the subprime mortgage debt in about 2006 and 2007 that led to essentially the crash that we had during that period of time. So these seemingly innocuous things can both mislead individual investors about a company's prospects, as well as, in some cases like the low receivables rate, lead to systemic changes in the industry that could affect the entire economy. So a few more items here. You can look up the source of this information if you want to here from the New York Society of CPAs. They're the ones who kind of came up with this list, and these are really quite common and actually effective if you're not on the lookout for them. Okay, hope this helps. Thanks for listening. Bye now.